financial accounting. Majorly, we are going to look at introduction to financial accounting. Financial accounting. Financial accounting has two words here that we are going to look at. One is financial, the other is accounting. Therefore, financial and the word accounting. Financial comes from the word finances or anything of monetary value. So financial comes from the word finances or anything of monetary value. Then accounting comes from the word accounts. Accounts is to give a report on something. Comes from the word accounts, meaning to give a report on something. So literally, when you talk about financial accounting, we are looking at giving a report on the finances of the business. Therefore, financial accounting is the act of recording business transactions and summarizing them into financial statements for decision making. By the users. So, financial accounting is the act of recording business transactions and summarizing them into financial statements for decision making by the users. We have various types of users of financial statements, as we shall see later on in our videos. Therefore, financial accounting is the act of recording business transactions and summarizing them into financial statements for decision making by the users. So, here we have some key terms I want us to look at. One is recording. Let me call them the key terms. One we have is recording. I know, and this is just to clarify somewhere, there is somewhere I'm going to look at some definitions when they have classifying. Yeah, that's part of it, but I will go with this as the major definition. Now, under things like summarizing, that's why we shall find the classifying and recording as well. We shall see it later on as we continue. Recording means writing down business transactions. Writing down business transactions. For example, in a business, we are transacting on a daily basis. So we give out receipts. So we write down the business transactions. We note them down in the books of what? In the books of accounting. So we write them down. We write down business transactions, in the books of accounts. Therefore, recording is all about writing down the business transactions in the books of accounts. Then we have business transactions. What are business transactions? Business transactions, these are events of the business that involve exchange of goods or services for monetary value. For example, a business can be dealing with services. For example, a barber shop. If you go for trimming of hair, that means you're going to be offered a service. Or you're running a school and you're offering an education service. Therefore, you're going to pay school fees. When you pay school fees, the child is going to receive education. It's going to be taught in the school. So here, this becomes the business transaction. That means you are paying money for a service. Or a business can be dealing in goods. They're selling goods. For example, you purchase, let me say, raw materials. When you purchase raw materials, you are going to get the raw materials in the exchange of money. That means you're going to give money and you're going to receive the raw materials. So that effectively becomes a business transaction. Let me give you a clear example. Let me say we are in a business setting, and let me say the manager of the business is upset about the running of the business and some issues. Let me say from the secretary. Then the manager slaps the secretary. As an accountant, you're not going to record that as a business transaction. Why? It did not involve monetary value or exchange. Therefore, it means anything that does not involve money or exchange of money, that one does not become a business transaction. But if the secretary was slapped by the manager, and later on we see the managers taking the secretary to the hospital using business money, that one becomes a business transaction, because we are using the company's money. We are using the money of the business. Therefore, that qualifies to become a business transaction. Now, there are types of business transactions. One, we have types of business transactions. One, we have the cash transaction. So the cash transaction means payment is being made on spot. You go to purchase goods or a service and payment is made on spot. So cash transaction, this is where payment is made on spot, either by cash or check. So a person can come to your business and they pay. For example, they take the goods and they pay immediately. They might either pay by cash or pay by check. It depends with what someone is that time is free with or has access to. For example, he might just sign a check and say, go get goods of this amount by check. That means he brings the check to the business. Or he might just pay by cash. That's if he has the money with himself or herself. Then the other is what we call the credit transactions. Credit transactions, these are transactions with deferred payment. Transactions which defer payment. This means that I can purchase a good right now, but I'm taking it on credit. I will pay later. I might not pay on spot, but I will pay later on. So a credit transaction is that which defers payment. That means I will take your good right now, but I might not be able or capable to have money to pay for the good that very time. So the next part from our definition is summarizing. Summarizing. You know, in business, you are not going to take all the documentations that you have done. So therefore, summarizing here, first of all, involves, actually we summarize the documents or the transactions that we have recorded. For example, let me say you have had purchases. We have the purchases books. You purchase goods, and every time you purchase a good, you record into the purchases books, right? Therefore, it means every time you're purchasing, you are recording. So after a 12-month period, which is most times the accounting period, 12 months. So after 12 months, you are going to be required to have the total purchases of that period. You're not going to get all the books that were written or where recordings were being made and bring them as a financial document. No. What we do, summarizing, involves getting the recorded transactions and posting them into the various ledger accounts, and then we extract a trial balance and we prepare financial statements. In our definition of accounting, remember we say that accounting is the act of recording and summarizing business transactions into financial statements for decision making by the users. Now, after us recording, we are going to get the recorded transactions and summarize them into the ledger accounts. We post them to the various ledger accounts. Then after that, we are going to extract the trial balance, and after the trial balance, we are going to prepare the financial statements. So the financial statements here, they include income statement and balance sheet, like we shall see onwards as we continue to go on. Therefore, when we talk about summarizing, we can say summarizing is the reorganizing of the recorded business transactions into financial statements. Summarizing is the reorganizing of the recorded business transactions into financial statements. Therefore, we are looking at the preparation of the financial statements here. Then, the other part I would like to talk about, there are the users of financial statements. Who are the users of financial statements? One, we have internal users and we have external users. For example, internal users, we might have the management of the business. They use the financial the financial statements to check the profitability, the liquidity, and the cash flow of the business. In fact, that is the major reason for the preparation of financial statements. We prepare financial statements to check the profitability, the liquidity, and the cash flow of the business. That's the major reason for the preparation of financial statements. But we are seeing the users of the financial statements. Basically, internal users, we have employees. Yeah, they can to check how they are doing, and the management as well. But now, there's something I want to help you get here. In case they ask you for the exam setting, and a question comes telling you or asking you to describe the users of financial statements. One, you define the user. Define the user. Then, explain the user. Explaining the user means explain what the user is going to use the financial statements for, or what is the responsibility of the user in the organization. So explain the user. What's the responsibility of the user in the organization? Define the user. Explain the user. What is the responsibility of this user? Then later on, decision making. What decision is the user going to take for the use of financial statements? For example, let me give you a clear example here. We are going to look at one of the users, let's say the shareholders. Shareholders are external users. Now, shareholders, these are people who invest in the business. They are not the people to run the business. In fact, they hire people to run the business on their behalf. So, these people who are hired are stewards. In fact, stewardship was the reason why accounting became known. Oh, it's the reason why accounting came to place. Because you are going to leave the business in the hands of another person. Therefore, you need to trace how are they doing. Is the business operating to what I expect to? So, therefore, shareholders, sometimes they are called investors. So here, we have defined who they are. Now, when you explain them, you say they invest in the business. They invest in the business. These are people who inject money into the business. Sometimes it's called capital. They raise capital that is going to run the business and the business operations. Then, what is the use of the financial statements to them? Now, the use of the financial statements, for example, the shareholder, it is to help them know whether the business they invested in is profitable or not. And the decision they are going to take is they should either continue investing in it or to withdraw from the business. So that's how we can explain it for the sake of the exam setting. You explain to us who this person is, their responsibility, and the decision they will make in case of in the use of financial statements. Then we can have. So you have talked about the use of financial statements. We have the shareholders. We have the shareholders. We have, this is external user. We have suppliers, external. Sometimes suppliers use the financial statements. For example, if we take goods on credit, they need the financial statements to see whether we shall be able to pay them based on our financial statements. So that's how suppliers use our financial statements. Because if they are to give you their goods on credit, you're going to acquire raw materials on credit, how will they be sure that you will be able to pay them Now, when you show them the financial statements, how the business has been performing and everything, so they will be able to ascertain that this person will be able to pay us in time. And then we have management. This is internal. We have our customers too. External. Our customers too are users of financial statements, and so on and so on and so forth. Therefore, basically, that's what we can talk about our introduction to financial accounting. We are going to see quite more, especially when it comes to financial statements as well. We shall have a look into it. We are going to dive more into these things, and we are going to continue. Thank you so much for watching my video. Subscribe, like, and share to other friends so that they can also be able to learn